All right, welcome back to Yahoo Finance on this Friday morning. We're about 3 minutes out from the opening bell. Let's talk a bit more about everything going on in the markets. We'll bring in Jared Woodard. He's the head of the Research Investment Committee at Bank of America Global Research. Jared, really great to have you back on the program. Let's talk a little bit about your latest note and something right at the top, which speaks to me about how the strong market we've seen the first half of the year really portends solid gains for the second half. And I'm just curious if you could talk through a little bit of these, what seem to me like early cycle dynamics that just, augur for higher stock prices as we accelerate out of the recession.
Yeah, well, it's a great point, Miles, and I'm glad to be with you all. It's been amazing this year to see the shifts in sentiment and concern in the market. In the second quarter, I think every single investor that I heard from asked me at some point about their fears of too high inflation, too much fiscal stimulus, too fast reopening, overwhelming supply chains, and so on. Inflation was the big fear, especially in the second quarter. In the third quarter, there's been a shift, I think, pretty clearly in sentiment around growth concerns and whether all these high estimates that people have penciled in would really come to fruition or not. And so when we kind of survey the landscape, we talk to our economists, we talk to our colleagues, and we find that actually I think there's not too hot inflation or too cold GDP, but almost just right conditions for markets. And historically, we looked, we've got data since 1871. You look at the U.S. equity market, and when you've seen first halves to the year as strong as this one, up 15% in the first 6 months. In the past, I think 16 or so times that's happened before. You've seen a stronger U.S. equity market to close out the year. Average returns of 8% with more upside than downside risk looking at history.
Jared, it's Julie here. So Goldilocks, effectively, which you mentioned in your note. But it's interesting how much angst there is out there. That, I think it's fair to say most people we talk to are not necessarily seeing what you're seeing in terms of this finely balanced economy and market here between not too hot and not too cold. What do you think people are sort of overweighting in their analyses?
Well, I think you're right, Julie. It's that wall of worry that markets always have to climb to reach higher levels. When everyone becomes convinced of a bullish case or a bearish case for that matter, that's where you get extremes in sentiment and positioning and big turning points in the market. We don't think we're at one of those turning points at all, in fact, because there's quite a lot of debate around these issues. That's how you get advantage sometimes in the market. I think what people are missing right now is the interplay between these big economic forces, between short-term supply shocks, most of which are either already being resolved or have a very visible path, to being resolved. For example, TSMC in Taiwan, I think, mentioned recently, some expectations about the semiconductor industry and how those supply bottlenecks might change in the future. You can think about lumber, which everyone was really terrified about a few months ago. Lumber's crashed something like 60% from the highs back in May. The big thing that investors are missing, I think, is the difference between the headline inflation data, those big, scary prints, and what's happening under the hood. Because when we look under the surface, we find a lot of factors that really are transitory, some things that might be persistent, but it's important too to remember that slightly higher persistent inflation, if it's 2.25% or 2.5% or 2.75%, on a consistent basis, that's an incredibly desirable position to be in for the U.S. equity market. Yes, higher than where it had been before, but people forget the Fed's been trying to hit their inflation target for an incredibly long time. Even if we overshoot for 3, 4, 5 years, we're still just making up lost ground in terms of inflation and, more importantly, economic output.
There you said the opening bell, Wall Street on this Friday morning. Stocks coming out of the gate nicely in the green. Blend Labs going public, fintech company going public today over at the New York Stock Exchange. Jared, you actually write about Fed policy being favorable. Why do you think it's favorable? Because the way I'm looking at it, I see potential tapering. I see rate hikes in 2020, 2022. Why do you think it's favorable?
Brian, I think that the tapering debate is a little bit overcooked. I mean, it's not irrelevant. It matters for markets on the margin, but the amount of attention that folks like us tend to put on Fed tapering sometimes I think gets a little bit excessive, just in the sense that it's not as great as risk, especially for the equity market, as it might seem. I think rate hikes are very important. Our economists expect the Fed not to hike interest rates until 2023. What really matters is when the market starts to price in those moves, and there we don't expect that kind of change until probably the second half of next year. And I'd say the Fed's made it very clear, whether it comes to the composition of tapering their asset purchases and the relation to the housing market, or the timing of interest rate hikes, they're going to do everything they possibly can to avoid any disruptions to financial markets. And so I think that the Fed is on the margin still incredibly easy, incredibly accommodative. And just as importantly, global central banks are turning easier. We found that over the past 6 months, there's actually been a stealth hiking cycle in the global central bank policy arena. You've seen 11 more hikes than you've seen cuts. And so it's one of the first hiking cycles in some years. More importantly for investors, that hiking cycle globally, I think, is coming to an end. People think in China, cut interest rates by a surprising amount a couple weeks ago, and they've kind of taken the leadership position for a lot of emerging market central banks. So we're likely to see, an end to that hiking cycle globally and a little bit easier policy around the world. That's all very supportive for emerging market economies and for equity markets too.
Something else, Jared, that you write about in your note is excess cash that a lot of companies have. Also, the corporate bond boom that we have seen. In other words, there's a lot that they have potentially to deploy. Would you describe this as a sort of coiled spring? Are we going to see a big wave of spending by companies? And how are they going to spend that money?
I think it's absolutely a great source of potential for upside for productivity and upside for markets. The reason is that you're seeing one of the fastest upgrade cycles in history in the corporate bond market. Credit rating agencies last year were very concerned about the pandemic and what that would do to corporate balance sheets. They, cut ratings pretty aggressively, and they're now reversing a lot of those decisions. So companies have the ability to raise money at some of the cheapest levels ever if they decide they want to expand operations. The sequencing is really important here. As you get fuller employment, you see more unmet demand in the market, more persistent unmet demand. That's what companies will invest in and rise to meet. They'll expand CapEx, expand property, plants and equipment, research and development, and so on. Then you have a full-on lending cycle where there's increased bank loans, more bond issuance, and that kind of virtuous cycle of development. We're in the very early stages of that process. In fact, we looked at data the last several decades, and we can't find a period in history where the ratio of bank lending to deposits was ever lower. So in other words, the credit markets, the lending activity is incredibly light right now. There's tons of scope for more upside there. We think that'll come through in the second half of this year, early next year, and that's going to have a virtuous cycle of higher productivity, more tech investment, more upside for equity earnings, and for markets too. I would add, in addition to the corporate cash, there's 2.5 trillion of excess cash on the balance sheets of U.S. households. So far, all of our data suggests that consumers are spending that cash, not in an aggressive, a volatile kind of a way, but actually pretty judiciously in a way that's going to provide a kind of a slow, steady support for expansion of consumption and GDP in the U.S. Again, a really positive for growth without threatening, excess inflation.
And Jared, finally, before we let you go, something you also mentioned in your note is you think that rates are going higher, specifically the 10-year will move back, in the neighborhood of 2% by the end of the year. And I think you have an interesting, view on this that we don't hear a lot, which is that if the Fed pushes back on rate hikes, it ultimately proves, well, I guess bearish for the Treasury curve, but it sets the table for higher rates. I'm curious if you could, maybe kind of tease that out for us.
Sure. Our rate strategist, our rates team expects, I think, a significantly, a fast, reasonable retrenchment of bond yields moving higher this year around to the 1.92% range. It's not a disaster for the bond market, but it does mean that Treasury bonds are pretty unattractive from our perspective as asset allocators. We favor, basically anything else in the fixed income market aside from government bonds at this moment. Certainly lower in yield, lower in credit quality. We'd rather take that business cycle risk than face the risk of higher interest rates. It's not hard to expect higher bond yields and higher growth in the medium term, higher inflation a little bit in the medium term. Nothing that would be disruptive to most people's portfolios, but would certainly make investments in government bonds less attractive than they've been historically. If you look at the correlation between treasury bonds and the stock market, it's never been higher, not for many years in any case. And so that hedging function of a government bond, the income that you historically got from a government bond, both of those advantages are absent today. And that's why in our asset allocation framework, we recommend investors shift away from treasuries and towards other parts of the fixed income market.
All right, Jared Woodard, head of the Research Investment Committee at Bank of America Global Research. I really appreciate you jumping on this morning. Great to talk to you once again, and I know we'll be in touch.
Thanks.